Okay. Good evening, everybody. It's Paul here. Let's look to begin. Good evening. It's Tuesday, the 8th of December, and we're here this evening to talk about longer-term trading using binary options as provided by Binary.com. For those of you who don't know me, my name is Paul Wallace. I'm primarily an FX indices and commodities trader. I have traded equities, and I started out on equities back in the late 90s during the dot-com boom, but primarily these days I'm mostly an FX indices and commodities trader on the longer term time frame, mostly around the weekly charts. And I also work as a trader development consultant to traders from all ends of the spectrum, from guys managing big books at tier 1 banks through to private traders working for themselves. So what am I going to talk about this evening? As I said, I hope you can all hear my voice and hope to see my slides, and hopefully this is just will have popped up there for you to see. Well, what I'm going to talk about we've got about the next hour is that I'm going to talk about, why do I use binary options in my own trading? What are they as part of my package? I'll talk a little bit about, actually understanding binary options. I'm hoping to sort of be able to sort of pitch this session at everybody, from somebody who's maybe an existing trader but doesn't really understand binary options, through to people who have maybe been trading either binary options or other instruments, and looking to sort of find a little simple way to add this into your toolbox. I'll talk a little bit about what's the use of them in terms of newbie and advanced traders, what can they gain from them, and then I'm going to talk about the particular ways that I trade, and talk a little bit about particular markets and time frames that I use. What I'll go on about then is I'm going to give you two very, very simple, specific tactics that you can take away from this evening's session, and we'll finish with a few slides on really, almost like your own binary trading plan. What is it that you could take away and use tomorrow? At the end of which, if there's time, I'll happily take any questions and answers. If you've got anything particularly burning as we go through, shoot it through, and if it's relevant, I'll stop and answer it there as we go. So just moving on. Well, what's my aim for today? Well, what I want to do, ladies and gentlemen, is to sort of impart my own knowledge and experience. As I said, I've been trading for getting towards about 18 years now, and in doing so, I want you to be able to help you progress on your trading journey by showing you how I've progressed on mine. What you'll talk or see this evening is that, a lot of the work I do, there's nothing really revolutionary there. It's just very simple principles that I know have been molded to my own trading personality over the years. But the important thing is that it's repeated consistently. That doesn't sound terribly sexy, I know, but the truth of the matter is it's about having good, simple principles that you repeat consistently day after day, week after week in your trading. But by the end of my session here today, I want you to be able to have a basic understanding of binary options. The Binary.com website has some fantastic trading tools and videos and pieces on there, so there's plenty there for you to fill your boots on there. But I also want you to understand, to be able to sort of the different types of trading binary options that I use, how I use them, understand a couple of very simple trading setups for the longer term time frame, and be able to start to involve them into sort of simple tactics so that you can use them in your own trading going forward from tomorrow. What I'd like us to agree on is some very simple points, namely that we all have an understanding of what the actual FX indices and commodities markets are. That you're happy with and understand basic trading terminology, and that you understand just very basic principles of trading and charting, things like support and resistance, candlesticks, moving averages, and that we agree on the fact that we never risk more than a small portion of our account on any one trade. That sort of risk management and money management is what runs deeply through me. So I'm going to presume that if you've never used binary options before, that you probably maybe come from a standard, let's say, spread betting or DMA or spot FX trading background. And what I just want you to think about is to maybe park the way you looked at trades there in that particular sense. In terms of using binary options, maybe there has to just be a little bit of an adjustment, a little bit of a change in terms of how you view those markets and how you look to engage with them. Normally what you talk about on a normal trading element is that, you know, they talk about having a normal risk to reward of about 3 to 1. And I'm very, very keen on getting people to think about, well, actually, making sure you manage risk and always think about how much you can lose. Whereas, with binary, it's an element of, in terms of your targeting, is also a little bit of thinking about how much you want to win as opposed to losing. And furthermore, that actually, in terms of to be successful using binary options, that you want to let time work for you. And in terms of the likelihood of generating increased profits tends to happen the longer that you can hold your nerve or ride your position for. Invariably, what tends to happen is lots of traders are very short-termist, intraday traders. The whole idea about this is about actually being able to give you a little bit of a simple understanding how you could use binary options to trade longer-term time frames, and in order to sort of help you generate some pretty simple, low-maintenance profits. So, for those of you who have never understood what is actually a binary option, well, the very simple definition is that it's about making a bet in the belief that you think a financial instrument, whether that be a stock, an index, a currency, or a commodity, it will either go up, down, or trade in a sideways fashion. A binary option is a type of option where the payoff is either some fixed amount or nothing at all. Thus, the options are binary in nature because there are only two possible outcomes. One of the kind of interesting points there is that, it's about a bet, and if you think a financial instrument will either go up, down, or trade in a sideways fashion. Invariably, when people come to where using options, their background has been maybe spread betting or direct market access or spot FX, depending upon where you are in the world. And invariably, actually, most traders are, momentum traders. They buy something because they think it will go up, or they sell something because they think it will go down, and the momentum will carry them through. For the first time, in terms of understanding maybe options and in terms of binary options, that you actually have a pretty simple and easy way to trade markets that are operating in a sideways fashion. And as anybody who's traded for a while will know, as much as we love trends in trades, and most people are trends traders, it can quite easily be 60 to 80% of the time a market can actually be moving in a sideways fashion. And binary options provide us with an opportunity to be able to trade that in a very simple manner. So I said that I'd talk about why do I think binary options are actually very good for complete newbies, people completely new to trading. Well, it's been my experience from looking at the majority of people I've seen or worked with or presented that most very new, uneducated traders are very poor risk managers. Invariably, they have too much risk involved in each trade, too little money management principles. If they're trading, let's say a spread bet or something, they move the stop losses when the trade goes against them. Or God forbid, they have no stop whatsoever because they think that every trade is going to be winner. And on the flip side of that, when they do actually have a winning trade, they tend to snatch at the profits. So here's a little bit of an interesting piece of information or quote for you. Is that and this comes from a spread betting company, is that their average spread betting stop loss for their clients was 16 pips. And the average spread betting take profit was 7 pips. Okay, so people tend to be risking 16 pips and making 7 pips. So they really are snatching at profits, and that invariably it makes it very, very hard for a spread bettor to actually be consistently long-term successful. But if they're operating under those particular averages. So, having seen that the downside, what's the upside? Well, the good thing about a binary option is that once you've bought the option, your risk is known, okay? Once you bought that option, your risk is known. You know what you've paid for that option. Furthermore, there's going to be no slippage like you might get on a DMA or a spread bet. Okay, there's no chance to move your barrier or your stop loss. Once you're there, it's locked in. And also a thing that people maybe forget is that there's no overnight charges. If you try and, let's say, trade swing or longer term positions on a spread bet or a DMA or something, or a spot FX, then invariably there will be overnight interest charges. Whereas there isn't with a binary option. Once you know it, you actually know what your cost is. Okay, you actually know what you've paid, you know what your cost, you know what your total, let's say your total capital risk is known, and I actually think that is really a key thing for complete new traders. Actually, your risk is completely known, and also you can close your position early. And I do have a particular rule about that for myself, but the majority of times, and certainly what we'll be talking about tonight, is if you're smart, you'll just forget about your position and let it play out for you. And the reason I say that is human beings, we tend to have a real need to interfere. We have a real need to meddle, okay, with a trade, right? We just can't help ourselves. We want to interfere, and that's pure ego. That's us thinking we know better than the market. And so actually, as I said, if you're smart, you'll have a position, you'll put it on, and you'll just let it play out for you. In terms of for those of you who are intermediate or advanced traders, why could binary options be good for you? Well, you're already doing the analysis, whether it be fundamental, technical, or even market sentiment. The question I would pitch to you then is, well, why not leverage that analysis to make extra returns? Even if you're only doing, I don't know, trading 5-minute euro dollar, I guarantee you'll probably be looking at longer-term levels of support and resistance. Okay, if you aren't, you should be. But the question is, you're already doing the analysis, so why not make the use of it? Why not basically use that add that to your trading toolbox? And what we'll talk about here this evening is a way in which you could just utilize 60 minutes of your week to take longer term positions. As I said, even if you're a 5-minute euro dollar trader, okay, you're probably still looking at having what the daily levels of support and resistance are. So you're already doing that analysis. You're already seeing those levels. You're already understanding what's going on a big picture, even if you're executing on a very short time frame. But the thing is, with these positions is that they're very low maintenance. You can just take an hour of your week to do the analysis, set up a trade, and just almost set and forget it. And invariably what I've also found, and I think it should hold true with most people, is that when you're a participant in a market rather than a spectator, you tend to have a sharper view of that particular market. When you actually have a position in it, you tend to be a little bit sharper in terms of your understanding of what's going on. Why? Well, because you have an element, you have an element of financial and emotional investment in it. So you could use this as a way and a mean to help sharpen up your own analysis and your own views on the markets. And the more you do it, the more that will particularly help you. So one of the things I'd like you to think about before we sort of dig into the main elements is that I can teach you a lot. I can teach you about markets. I can teach you about different trading methods. I can teach you about sort of money management, and I can also teach you a little bit about yourself. But the one thing I can't teach you, the one thing that has to come from yourself, is about knowing your own risk profile. Okay. There is a spectrum there between risk and reward, and everybody sits on it. And one of the most important things you can do for whatever type of trading you're involved in is to know where you are on the spectrum. So there may be positions or maybe things I talk about this evening that some people would say, that's far too risky for me, that's far too risky for me. And then there'll be other people looking at maybe positions that I've taken or what I would do, thinking, that's actually that's a bit slow, that's a bit dull for me. Everybody sits somewhere on that risk to reward spectrum, and you have to know your own risk profile. And all I'd ask is, if you see things that I talk about this evening, it's just, just respect that we're all in our own place on the spectrum. There's nothing necessarily right or wrong where you sit on that particular spectrum. It's about knowing what type of trader you are and being able to work within that. For example, if you're a very risk-averse person trying to trade, really very sort of very, let's say, very greedy, sort of aggressive trading style, it's just not going to suit your personality. It's not going to suit your risk profile. So be honest with yourself. Know your own risk profile. If you don't, spend a little bit of time getting to know it, because that will help you enormously. So, what are the different types of binary trading opportunities? Well, I see them as kind of two types. Type 1 is a trade that is a very low probability but a high payoff event. Some people might term that as as a kind of a way out of the money option. It may be, but realistically, what you're looking at is that you'll have a low probability of success. It may only be between 5 and 20% in terms of your hit rate, but you have a very high payoff. So it might be 8-to-1 reward to risk plus. Okay, so some people will like that. Some people will be very happy. They may only be right 2 times out of 10, but every time they're right, they win. Let's say £8, and every time they lose £1. Okay, so they'd be a low probability but high payoff events. Alternatively, you have type 2, which is high probability but lower payoff events. A lot of that is normally because you're a little bit closer to the action here, where you're putting your options positions is normally a bit closer to the action. So you have a higher probability of success, so your hit rate can sort of nudge towards like 65 to 90%, but your payoff is much lower, and it might be sort of 0.7 to sort of 1.5, 2-to-1 reward to risk. These are the ones I tend to focus on. That doesn't necessarily mean it's the type 2 is better than the type 1. It's just different ways of viewing the actual market and different types of binary trading styles. Once again, it's about knowing your own risk profile and about knowing what type of trader you are. Because I have been doing this for a long time, because I spend all my time doing sort of analysis of all those markets, I am much happier and much more confident, have much more self-belief in my own analysis, and that allows me to sort of to be happy to take such positions. So if I was going to give you a sort of a very simple sort of way to take away in terms of how to succeed with binary options, well, I put it down to the 4 Ps: planning, patience, probabilities, and pounce. What do I mean by that? Well, you're about to learn about this, ladies and gentlemen. Part of it is about plan, all right? About doing your analysis, building a trade plan, and then because we're going to be trading longer term charts, it's about having the patience to wait for your setup to come to you. It's then a little bit about understanding probabilities, okay? And once again, understanding those probabilities links into your own risk profile, but the simple way to do it is the more you do it, the sharper you get. And then finally, being able to pounce. Once you've done your plan, once you've had the patience to wait for it, once you recognize the setup is in your favor, you need to be prepared to pounce, so actually to take the trade, build a position, and get on with it. So there are, I won't lie to you, there are lots and lots of, binary options brokers out there these days. You only need to go onto Google to look at that. So why do I use binary.com myself? Well, if I had to sum it up in one word, it would be flexibility. Okay. I get to choose how much I'm looking to win, which is a little bit of a mindset switch. But the most important thing for me in my style of trading is that I get to choose when my option expires, and I also get to choose the exact barrier level, or the level that I want. And what I found is that controlling price, time, and levels gives me immense flexibility. So what you may find other options brokers, or there are other binary options brokers, you may, the time may be set as in, it may be, a set number of days, or a set number of weeks, or a set number of months, or the levels are set as in a ladder that goes up on, let's say, on an FX, it might go up on let's say, a 100 pip move, and the price might be, a case of a very rigid in terms of, what you're able to sort of trade at. Binary.com gives me the flexibility to control price, time, and levels, and that amount of flexibility is what allows me, and it makes me happier to take positions that have a higher probability but a lower payoff, because being able to control the price, time, and levels around my normal analysis of markets makes a big difference and helps me in normal. So there are a few different types of binary option trades. I'm going to really talk about the two that I use mostly. That's what I want to talk about. The first type is a touch, no touch trade, and the second one is an in-out trade. Some of you may be well aware and very comfortable with that. Some of you may be completely new to binary options. So I would ask those who are experienced just to bear with me for the next couple of minutes as I explain, my view on those type of trades setups. So what is a type touch no touch trade? Well, as you can probably imagine from the title, a touch trade is you believe the market will touch a given point at least once before the contract expires. And on the flip side of that, a no touch is a bet contract is the opposite of the one touch. You would buy no touch if you think the market will never reach a certain level within a specified range of time. Okay. So let's see if what would happen is if once we look on the binary.com website and you select your touch or no touch, you can see this is one for the Kiwi dollar. I can put the duration. Okay, remember I said controlling sort of a price level and time is key to me. So I'm able to put in exactly how long I want my let's say my position to be in. I can put in the actual level, the barrier level that I'm looking at, and I can choose the kind of the price in terms of what I'm looking to win. And the binary.com website will then give you two options. If you want to purchase a touch, okay, which basically he thinks that it'll pay out, in this case at $3,000 if Kiwi dollar touches 63.80 before, okay, the 9th of February 2016, well, that would cost you so much. That would cost you, in this particular case, $1,472. And what you can see at the bottom there is it says what your net profit would be and also what your return would be, okay? Or alternatively, maybe you think that barrier level of 63.80 is a level that you want to, that you think won't be touched, okay? And invariably, if you want a does not touch, a no touch, okay, option. So to win $3,000, it would cost me $1,800 to buy that option, which means that when the position plays out, let's say it doesn't touch that 63.80 level, that I win $3,000, which is you can see there's what my overall net profit would be and what my return would be in that particular 66%, or that you're looking at just under 0.7 R. Okay, for those of you who understand reward and risk ratios. So that's how it kind of looks on the platform if you've never used it. But hopefully, he says. Here's like a little bit of an example in terms of a touch. So this is a weekly chart of the euro dollar case, just really my kind of normal, one of my normal charting packages, because remember we're looking at longer term trades. This is a euro dollar weekly, so every candle is a week. Okay, so you can see for yourself what's happened is that price at the moment is this is the weekly thing. It's just been coiling up. Okay, this is from about a year or so ago, and what you may think, well, do you know what, Paul? My analysis is that price is coiling up, okay, at the moment. It's forming a little triangle or a pennant, and I think it will explode out of there before the end of the year, and invariably I think it will move up to either the recent highs from earlier in the year or the recent lows, and what I'm going to do is I'm going to buy a touch option because I think price will either go up to the highs or down to the lows. And that's what you're really looking at. And this is just a simple analysis that that you can do at a very quickly and very simple analysis of the market, analysis of trend, analysis of support and resistance levels. Or alternatively, maybe you have, maybe your view is that, you think that, all right, price is coiling up, but actually, I think that price will break out of that triangle. It's a continuation pattern. It will move further north, and that price will never get back down to those lows. And so what I'm thinking I'm going to do is I'm actually going to buy a no touch down at that level. Let's say it was like 121, okay, although normally people can remember when euro dollar was 121. But, it's a case of price can be down there. It's not going to touch there for the next, let's say until the end of January. So that's what my no touch binary option will involve. Or alternatively, maybe you think that, price goes up and then price actually, goes into this sort of congestion, and then it rolls over and it continues down, and the price is never going to get back up to those recent highs. So then you'd be looking at buying a no touch, running for the next few weeks or months, depending upon your risk profile. So that's really very simply, how you would maybe look at using a touch or a no touch based upon your analysis of that particular market. The second one we'd look at is what's called an in-out. Okay, and not surprisingly, as you can probably understand, if you select stays between, well, you win the payout if the market stays between, okay, your barrier levels. Or if you select go outside because you think that the market will, let's say, break out of congestion and will go outside of that area. Raj, you're talking about what the arrows indicate at the top. Well, that's just a view of where you think that the price would move, and I'll show you that again on the next example that I'm going to pull up here. This is just the platform itself. Again, you select in out. This is on the the US indexes for the S&P, and for an in out, well, you just select your high barrier and your low barrier levels. Okay, and if you think that price is going to end between those levels, well, then you'd be looking to purchase an ends between option. Or if you think that it's actually going to break out of that level of congestion, then invariably you're going to look to buy an ends outside option. And so that gives you the flexibility to basically set the duration, to set your barrier levels, and also to select your payout. And it's that level, as I said, that level of flexibility that is very attractive to me. So here's an opportunity. It's that same euro dollar weekly chart, but maybe you as a trader, you've been watching the fact that for the last few weeks the euro dollar has just been coiling up, but actually what you think is that it's going to just run quietly till the end of the year. There's nothing is going to happen, and that actually nothing's going to happen till the new year, and so you look to take an in trade, namely you work out what the high and low of that little area congestion is, and then you place that into the binary.com website, and you actually look to buy a remains within or ends between, okay, option that will run for, let's say, for the next few weeks. Alternatively, maybe you think as a trader, well, do you know what, this little period of congestion is coming up, but actually it's just coiling up. Price is going to coil up, and then it's going to explode out. Which way is? I think it'll explode out of that range before the end of the year. So you'd be looking for ends outside and out, because it only has to get outside and touch and end outside of it. Then invariably, then that is a winning trade for you. And it doesn't matter if it just ends outside, by 1 pip or 1,000 pips. Okay. The important thing is it's about the options levels, and that's what you have selected. And that's another great thing that makes it a little bit easier for new traders, is that they're not trying to sort of snatch a profit. Okay, once a position is in profit, doesn't matter whether it's in profit for 1 pip or 1,000 pips. It means that you'll be getting the same outcome. So I talked about those 4 Ps: planning, patience, probability, pounds. So why don't we start to look at a few SERPs and a few tactics and talk about how would we do it if we were, let's say, looking on a Friday afternoon to start to actually put a trade on, start to build a trade plan. So when it comes to your planning your trade, that first P, well, the 4 things you want to be aware of is what's the market that I want to place a trade on? What's the type of trade that I want to take? What's my time limit? And also, what are any critical levels or news that are in front of me? So in terms of the type of market to place a trade on, the markets available to us are FX indices, commodities. Binary also now provides some equities and also some random indexes. But as a general rule, these are the 3 that I trade most of the time. So it's the big picture FX, big indexes, and commodities like gold, silver, oil, etc. So you want to know what type of market you place trade. And the thing is, if like me, or you're already doing analysis on particular markets, you already know what you're looking for. That will come very, very quickly and naturally. Your second part of your plan is, well, what type of trade am I going to take? Am I going to use something like a touch or no touch, or am I going to go for an in-out, ends inside, ends between, or ends outside? Just know what is the type of trade that you're looking to take. Then the third one, okay, this is introducing an element, the time limit of your position. So simply that time that you're putting on your market, doing what your analysis predicts. And here's a rule of thumb that I tend to use, and once again, ladies and gentlemen, as I said, it comes down to your own particular risk profile. But as a rule of thumb for my own positions, if I'm taking position off the, let's say, the weekly chart, I'm looking for it to run for between 4 to 6, sometimes up to 8 to 10, but as a general rule, between about 4 to 6, 4 to 7 weeks. That's what I find that I'm comfortable with, and that's what I'm happy with. Now, of course, what will happen is, some people might only want to run a position for a week or two. Well, invariably, what you have to realize is that, if you're only running it for a week or two, then actually, in terms of the profitability of that position may be reduced. Alternatively, some people might say, well, do you know what, Paul, I might want to put a position on for for 3 months, for 12 to 16 weeks. Okay, and of course, invariably, then in terms of your profitability, that will increase, but the probability it probably will decrease. So, as I said, it's all about understanding your own risk profile and all about understanding what it is you are comfortable with. Alternatively, if I'm taking positions off monthly charts, which is what I will do, some of those positions will run from 8 to 26 weeks. Okay, so sometimes I'll put positions on running into the summer. Okay, where I might take positions for weekly, because what I know is that during the summer, as a general rule, markets tend to get very quiet. They tend to go into a range between sort of late May, June through to sort of September. And then invariably after that, what happens is, we'll have things like, the last few months of the year can be a little volatile. We might get Santa's rally, so we'll get movement. And so I will amend my positions accordingly. So just something to think about there. And then the fourth part of your plan is the critical levels of news. What you want to be aware of is you want to be aware of those big support and resistance levels. Okay, have a look on the daily and the weekly and the monthly. Be aware of them. Be aware of them. Are there any big round numbers in the way of what you think analysis is predicting? And also, are there any real major fundamental news releases coming out there? So, for example, here's an example. So, if I have positions that I'm running let's say until the start of a month, let's say I'm running position on US dollar or the US indexes, and what I will tend to do is I will tend to have them to complete sort of just before things like NFP or just before the FOMC announcements. Okay, simply because I know that they are always going to bring volatility into the mix, and I actually want to be sat on the sidelines, quite happy with my position close and profit in the bank beforehand. So just use a little bit of common sense. Just start to understand, when you're looking at position, what are the big support and resistance levels? Are there any big round numbers, psychological numbers in front? And when you're choosing what time you're going to finish at, just have it in front of big news announcements rather than after it, just to help reduce the risk. Once again, that might also be, that's an element of personal risk profile. I've just learned, the hard way, because invariably we always learn the hard way. Invariably, that actually what you want to do is to have those positions, out before major big news comes in. So this is actually just a chart of the this is the S&P, the 500. This is the weekly chart, and this is just something to look at. These arrows are just whatever price has been in an uptrend. Okay, it's a weekly chart. Every time price pulled back, it normally ended its pullback with a nice thing like a pin bar, a rejection candle. Lots of people trade them. Very, very simple. They stand out a mile. But the challenge, let's say, the challenge most private traders are going to have is that, if you get a pin bar on the weekly chart, the actual size of that pin bar, in some cases, may be 4, 5, 6, maybe even 700 pips, which means your trade risk in terms of your number of points at risk is quite large, and also your account risk, your capital risk. Okay, it may not actually fit within the size of the account you have if you're, let's say, trading on a spread bet or a DMA or a spot. The difference is, okay, here for when you use a binary option, is that pretty much all I was doing was every time the weekly pulled back and put in a pin bar or an engulfing candle, I was able to put like a no touch underneath, okay, underneath those weekly pin bars, put it out for the next, buy it for the next sort of somewhere between the next 4 to 8 weeks, based upon the pricing I was being given, the probability, and just let the position run. Let the position run, because I could choose how much I wanted to win, and with that, I also got a very clear idea on how much I was prepared to risk as part of that. And so I was able to just basically put no touches underneath all of these positions, let them run for, like I say, 4 to 8 weeks, okay? And those trades just played out. Those trades just played out. Very, very simple. Very, very simple. No, it took me, sort of, 15, 20 minutes at the end of the week, and about, maybe sometimes a little bit of half an hour over a weekend, which was analysis I do anyway. I'm a weekly trader. I still trade SpotFX. I still trade, I still have just normal positions, okay, DMA, not so much spread betting these days, but, I still trade those kind of main accounts. But what I have is, these binary trade options, no touch and touch, just gives me the opportunity to basically to leverage my analysis to do better. And what have I got here? And so this is actually looking at this is the S&P 500 weekly at the moment, and invariably what I'm looking at is just doing the big analysis, and invariably once as I said, over the summer months, okay, where the price just started to go very sideways, very slow. And then once the China event happened at the end of August, I was able to start putting in no touch options, okay, above the S&P 500 running till the end of the year, because I just genuinely didn't, once it started to roll over and collapse, I just didn't think it would get back up and make new highs before the end of the year. And so that's been running there, okay. And then invariably what happened is, you can see probably price bounce, put in that lovely kind of big 1, 2, 3 pattern on the weekly chart before it launched itself off again. And then once it did start to take off, you can probably see the purple lines where actually I was placing no touch options trades beneath the price there, just letting that run for a bunch of weeks. And then at the moment, I'm actually keen watching on whether S&P just goes into a bit of a kind of a sideways congestion period till the end of the year, because it's a pretty big range. So the thing is, it's very simple. I'm going to show you a few specific tactics and such now, but because you're looking at the weekly charts, and that means you only have to look at that maybe at the end of the week on a Friday. If we'll give you one tactic, or you can look at that over the weekend. And it doesn't take long to look at those weekly charts. Remember what I talked about. First, it's about having that plan. It's about basically just understanding what's the patience to wait for it. Things aren't going to happen overnight, which is a blessing for most people, okay? And then also what you have is understanding the probabilities, and then just being able to get ready to pounce, to have a scenario analysis, so that when something, when ABC happens, you do DEF. This is kind of like, this is a trade on the sort of the dollar yen. Okay, so this was from sort of September and October of this year. You look at it. If you, I do kind of weekly and monthly webinars and market analysis on my blog, and invariably we talked a lot this year about this kind of 118.50 level, which has been a support level for dollar yen. And invariably what happened was it just, price just started to, it was just went into a very congested box. This is the daily chart, and invariably what happens is sort of mid-October, once we've bounced out and come up with it, I believe that we would break out of this particular box and wouldn't return to it before the end of the year. And so I have a trade running there on that, okay, that's come along. And also I have a no touch on the 118.50 level, because it's just a very strong level of support. So it's just a case of just as I said, just doing a bit of simple analysis. There's no rocket science. There's no need to be a superstar. It's just about just using very simple, consistent ideas, using them time and time again, okay? And because you're using the bigger picture, you have the time to view, you have the time to create a plan, and you have the time to just effectively set and forget, and then move on. So what I'm going to do is, having just hopefully that's given you a bit of insight into what you can do. what I'm now going to do for the rest of the time is cover a couple of very simple tactics that you can take away, and you can go away and start looking at the charts from tomorrow, okay, and start to have a look at, how could, using the, how could using the binary options help you make trades within those kind of markets. If let's say the weekly and monthly charts have been outside your particular existing risk parameters. So the first one I'm going to use is an engulfing candle, because I wanted it to be something very simple that people probably already look at and recognize and use. It's just about using it in a different way, in a different style. So for those of you who've never heard of an engulfing candle, well, it's pretty much the opposite of an inside bar, and effectively, as the name implies, the high and the low of the bar engulf the range of the preceding bar. They're less frequent than things like inside bars and pin bars, but they're very, very powerful. Okay, especially powerful when they happen at the end of a trend. Okay, and they can be used to help signal a significant change in trend or sentiment. And this is something that we starts to give us let's say the idea about a possible trade for ourselves. So, I'm sure most of you will probably be aware of engulfing candles. So it's a two-bar setup. The first candle closes in one direction, the second candle reverses and goes in the opposite direction. And ideally, what I suggest to people is that, to begin with, it shouldn't have any large tail to either side. What I like to see with my engulfing candles is big, strong, bold candles. The reason being is it's giving us a psychological statement, okay? In this particular case, any downtrend was over, the bulls have stepped in, the bulls have wrested control, it's the bulls in charge now, and so the next, the probability of the next direction being up has increased, okay? And when it's happening, when you see these happen on weekly charts, it doesn't happen very often, but when they do, you don't really want to be fighting it. So if you want to take screenshots, here's a couple of examples. Okay, you'll hear it called engulfing candles or outside bar. But as I said, what you want to see is big, strong, bold, candles that pretty much leap off the page at you anyway. And there's a little thing what I've always talked about is that an outside bar close, it must be higher than the previous bars open. That's why this one here on the right of the screen, that whilst the range of it engulfs it, what I like to see is also that it's a big, you see a big, a big strong body on your candle. Alternatively, for bearish examples, then invariably you want to see a big, strong bearish example. I want to see a big, strong candle, and the outside bar or the engulfing candle close must be lower than the previous bars open, and that's why this one is not what I would call a proper engulfing candle. So, they're very simple to see. For even the most newer traders, just you could look at monthly, weekly, daily, even 5-minute charts. Where every chart, engulfing candles happen, but it's always an element of you want these things happening as a confluence of events. Ideally, we want an engulfing candle happening at the end of a trend, and if it's also at a level of significant support resistance, well, and then we've got an engulfing candle. It's a confluence of events, 3 or 4 things all happening at one space in time that gives you the sort of the increased let's say confidence to take that position. So how would I trade it? Well, the very standard, simple way is that, what I'd be doing is I'd be using a no-touch barrier trade. So I'd be looking to set, a no-touch barrier option, that is probably about 30 to 60 pips above the high, in this case for a short trade. And then I'm looking for my option to, as I said, run between about 30 to 60 days. And we're looking here about, as I said, about 4 to 8 weeks. A lot of that is based upon the price I'm given and my personal risk appetite. You may want to go long, you may want to go shorter, and if the option's at the right price, well, then you can take it, and then invariably, for the most part, you can forget about it. My weekly positions, what happens is that a lot of them go on either very first thing on Monday morning or last thing on a Friday, and I may not actually check them until, you know, the week later, okay? Just quick check-in once a week. Very low maintenance, you know, almost, you know, just kind of set and forget those positions. As I said, one of the things that might help some traders is that you know, we have a you know, as you're building your own discipline, people tend to find that they are what's the word? They're always basically wanting to interfere in their trades. Okay, they always want to think they know best, and the long and the short of it is most of the time we don't. Sorry, this was a chart on the gold. Gold had actually, it's in an overall downtrend, but it had a little bit of a pullback. Then I get, you know, a big, strong, bearish engulfing candle. Okay, there's a no touch barrier trade above it, and then as you can actually see for the week, in fact for the next, you know, 3-4 months, okay, until it runs into the longer term moving average, it never gets above, it never gets back above that level, and so that trade played out as a successful trade. Very simple, didn't take very long to do, and literally, as I say, kind of set and forget. This is one from very recent. This is, you know, the commodities. You know, they've been in a, you know, they've been hammered, okay, most this year. This is silver on the weekly. Just for my charts, it's like a 20 period moving average, a 50 period moving average, and a green 200. Desperately simple, okay. But price had actually, you know, having hit its lows, it pulled back, formed a lower high, and then also actually, you know, we had a rejection candle of which the range also engulfed the preceding bars. There was a no touch placed above that. I think that's still there. That's still running. But here's another little thing, is that I actually placed a much smaller touch trade in front of what I deemed to be the sort of the support level. Remember what I was saying a few slides back, is that you want to have an idea of, you know, significant levels of support resistance, significant numbers. Well, you know, this kind of, you know, running into, it was around just under $15. Okay, it was a significant support level. So I actually, it was a much smaller trade, much smaller touch trade. Okay, and actually that played out, and that finished up a while back actually, because the collapse in silver happened so rapidly. So here's how you start. You know, maybe in the future ones, will start to talk about building synthetic positions, where actually, you know, you can have no touch but also touch positions if you're looking where you're predicting, you know, price to actually end up, and as a smart and experienced trader, you'll be able to take that on board. These are some examples here, okay, on the Euro Aussie, okay. So the weekly Euro Aussie price is below the 200 and 100. It's been in a downtrend after a little bit of a pullback. The Euro is weak, the Aussie strong, and then invariably, you know, we have a bearish engulfing candle. Next week it becomes a corn trade, so there's effectively a no touch placed above the engulfing candle, and as I said, looking for it to run for a few weeks into the future. Don't worry, you're about to learn to understand what a corn trade is. So what do I do to help kind of maximize my profits? All right, what do I do with, like, an engulfing candle? Well, a lot of this, as I said, comes back to your own risk appetite, but you've got two options, all right? And this is about helping you to maximize the returns. The first one is what I'd call an early entry. Normally, when I would trade anything, and I would advise anybody that you never take a position until the candle has closed. As I said, with binary options, sometimes you use that a little bit differently, because especially if you're doing it on a weekly, right? If you believe the bar is going to close an engulfing candle, then what you might do is look to enter a little bit early on the Friday evening, because you're likely to get a slightly better prices, but you're likely to get the probabilities just in your favor a little bit better. So if you're trading something like, you know, the European indexes, okay, so this is what you need to be looking at, how that bar is going to close before about 4:30 on London time. If you're trading on like the US indexes, okay, then invariably, you know, you're looking at that before, I say 9 p.m., but a lot of it, as you'll know, depending upon whether you're in summertime or not, and invariably for FX, okay, a lot of the FX will close at, like, you know, 5 p.m. US New York time, so invariably that's London time, you're looking at, you know, before 9, 10 p.m. So you really, if on the weekly charts on a Friday evening, take a little bit of a look, have a look at if that candle is going to close, is likely to close an engulfing candle. But what I mean by that is, here's an option on the S&P. S&P has been in a big weekly downtrend, and at about 5:30, 8:30 on the Friday evening, I see that the weekly S&P bar is looking like this. Okay, it's big, it's strong, it's bold. The likelihood is that, you know, within the next half an hour, it's going to close as a weekly engulfing candle, and I'd be looking to place my kind of no touch underneath that again. I'd be looking to get that trade on early. So that's a good example. A poor example is, let's say, the S&P has been in that weekly downtrend. I've checked in at 8:30, and actually what I see is that the S&P bar is looking like this. All right, I'm not going to be able to trot on this. Okay, that's not really a proper engulfing candle, and actually that candle looks more indecisive than a bold statement. So if I'm going to take the early entry, it's only when I get a really bold statement there. Okay, I'm not just doing it because it looks like the range is bigger. I want to see a very strong statement. The second option is a retracement. Okay, once that weekly candle is closed, maybe you're just unable to get that early entry option. Maybe the Friday evening you're doing something else. All right, and maybe the price offered on a Monday. Okay, we know the reward to risk wasn't suitable. But what you can invariably do is sometimes you'll see, and if you look at this is a good example. Is after the movements in US dollar at the end of last week, if you look at dollar index and you look at a couple of the other particular dollar pairs, especially things like euro dollar, etc., there's a very big bullish engulfing candle, but actually we retraced the last 2 days. Okay, we had a bit of a retrace, and actually once you've got that retrace going, then invariably what you'll look at is if you go back to the options pricing, well, then you'll see that perhaps the reward to risk will become more favorable. The downside of that is sometimes price will just take off. Okay, there'll be a big engulfing candle on the weekly, and on the Monday the price just takes off and continues in that direction. All right, and when that happens, well, you just have to realize that the train's left the station. Never chase the price. Okay, if you've missed that opportunity, you just missed it. Okay, the thing about trading is that they will come again. Trust me, they will come again. So here's a little example here on the weekly chart, the engulfing candle. Okay, and these what arrows are here. Okay, this is the weekly chart over about an 18, nearly 2-year period, and in that particular case, just on the euro dollar, there were like 7 proper engulfing candles, of which six played out. Okay, 6 played out. This one in the middle here that failed to play out. Okay, but the other 6 all worked out. Now, of course, some might say, well, Paul, 7 opportunities over 18 months to years is not a great deal, and you'd be right. But the thing is, remember, we're looking at the weekly chart here. It doesn't take long to identify this. You can start looking across all of the FX pairs on the binary.com website. You can look across all the indexes. You can look across all of the commodities. So that gives you, you're close to having about 40 instruments to be able to look at. So, once you've got 40 instruments, well, then actually, of course, the number of opportunities starts to go up. Remember what I was saying, this is longer term trading. This is the kind of very simple, low maintenance positions that you can put on and just let run for your own good, okay? Simple, easy, repeatable tactics that you can just use week after week after week. You just have to have a little bit of consistency. That's it. And so, as I said earlier, okay, this is the euro dollar on the weekly chart. Okay, you can see that last week you probably already have seen it yourself. That invariably we had a very big bullish engulfing candle there. Now people can all talk and discuss why it happened, and there's I don't think it's necessarily the end of euro problems. But remember, I've looking at just basically a no-touch, barrier trade beneath it running into the new year, because the ball, it was so big. I think it's unlikely that the price is going to get down and touch that in the next 4 to 5 weeks. Okay, and what we saw was it basically has retraced a little bit, but has started to bounce back up. So if you weren't able to get in on that on the Friday, when the price started to retrace back down to that support level, okay, or level on Monday morning, that would have given you a better price to get your no-touch barrier trade entered. So that was the first tactic. Because most people, I wanted to keep it simple, because most people know what an engulfing candle is, but maybe you've not been able to use it on a weekly, because on a weekly, an engulfing candle might be 600 pips, okay, and that might just be trade risk and capital risk way outside your, your account size remit. But actually, with a binary option, well, you can just put your no-touch barrier underneath it, okay, and just put the trade on for 4 to 6 weeks, walk away, leave it, easy. The next one is a thing called a corn trade, all right? Some of you may have heard of what a corn trade setup is, some of you may not. Very, very simple. Once again, I always like to sort of just help people with very, very simple, easily identifiable setups. So for a long trade, you're going to look for 2 buyers bars in a row, and one of them must close above the 20 or the 21 period moving average. There's no real difference between 20 or 21. If you're a spread bet or a DMA or SparkFX trader, well then you put your buy stop above the high to buy, and you put your stop loss, the candle away. That's what would be your normal kind of, let's say, normal trading style. So here we have this. This is a trade on Aussie Swiss, a long buyback. So, we've got 2 buyers bars in a row. Second bar closes the other side of the blue is the 20 period moving average. It's closing the other side of it, and the whole idea behind it is that you expect to see momentum come in, and then that should carry on for the next few periods. Of course, if you're using this on a weekly chart, well, then invariably when this happens, you're expecting it to carry on, okay, for a good few weeks. In this particular case, it went on for a good few months. But that's what we're looking for a long corn trade setup. It's called corn trade because it came from a guy who just traded this way, or you trading corn on the Chicago Mercantile Exchange, okay? Desperately simple, okay? You could use it across any time frame, but for using this as an options trade for binary, it's a very, very simple way to get you started. For a short trade, you're looking at 2 seller bars in a row, and one of them must close beneath that 20-21 period moving average. And then, as normally you'd expect from spread bettors and such, your stop would be the other side, and your stop loss would be the candle away. So in this particular case, I think this is a euro sterling. The price has been in a long downtrend. It pulls back. The first one's an inside bar. The second bar is 2 sellers bars in a row, and it's closed beneath that 21 period moving average, and the momentum's in. Now on a weekly chart, I said that bar might be pretty big when it could be like 350, 400 points. So for a spread better, having your stop loss of 350 points away might be just a little bit, might just not necessarily be what you want. But with this, what we have is the opportunity to look at it and act it very differently using the corn trade. So it's a very simple yet remarkably effective way to enter momentum move, and here's how we use it for a weekly binary. So we set a no-touch barrier below for long, or we set a no-touch barrier above for shorts. And once you get it, I'm looking at it for running for like 30 to 60 days on the weekly chart. So in this is the euro sterling. Okay, so we have 2 seller bars in a row. We're in a longer term downtrend. Second bar closes the other side of that 20 period moving average. So invariably then we start to put a no touch above bar 2. Okay, bar for the next 30, 60 days, and what do you know? In fact for the next 2 months, 2.5, nearly 3 months, it never gets back up to touch that, and the trade just closes out as a profitable one. Euro yen did the same. Okay, it's invariably once we've seen the second bar there is closed, this is the weekly chart, so that second bar is probably going to be very big. It's probably about 250, 300 points. But actually, what we're looking at is you start to put just no touch barriers above that second bar, and that's what allows you to run. Okay, and it doesn't matter how far it goes, so long as it doesn't touch that, the trade is sorted. This was the Euro Aussie weekly trade. Okay, it's effectively 2 seller bars. First one was a bearish engulfing candle, and invariably the second one closes beneath that 21 period. The longer term down trend is down, so invariably it allows you to put a no touch barrier trade behind it and just let the position just play itself out. And that's what you're looking to do. Very, very simple, just working from momentum play to work out. This was that Aussie Swiss trade. Okay, we had 2 buyer bars in a row. The second one closes the other side of the 20 period moving average, and then invariably you have no touch beneath that, and then the trade just runs on and on and on. Here's the pound against the Swiss. I tend to have like kind of longer term time moving averages above. Okay, just to give me an indication of the big trend. All right, we know that we want to basically trade in the direction of long-term trend. 2 sellers bars. The second one is a big bar, okay? But invariably what you're doing is you're putting a no-touch barrier above it and then just letting it play out. Remember, 30 to 60 days, that's effectively, you're looking at 4 to 8 bars, okay? So even when it pulls back here, okay, that trade still played out as profitable because it didn't touch our level. And then what happens, it sets up again, the no-touch goes on, and it runs away again. And that's what we're looking at. Just desperately simple ways to move along. So just the last couple of slides, just to finish. I know we're just overrunning it just a little, but as I said, I like to see the 21 period moving average and the 50 and the 100 very close. That's what gives me a bit more confidence and trade in the direction of those longer term averages. If you've got a really large second bar, well, you can use that no touch barrier above that. But if the bars are very small, then maybe you might want to put them behind both bars, okay, or a relevant level of support and resistance. There's an element of using common sense, just looking at it and just looking at what the chart is telling you, because the market is always communicating to you. So just the last 2 slides or so, I think, to finish it off. How do we bring it all together? Well, for weekly trades, if you're looking for that early entry, well, then you want to start checking in between about R3, R4 for the UK and European indexes. You want to be checking in, from probably, I say 1900 to 2100, but that can be sort of 8 till 10, depending upon the time frame for start looking at some of the US indexes and also the FX pairs. And you're looking for, see if you want to get an early entry on some engulfing candles if they're setting up. So there were a few setting up there last week. Alternatively, just do your analysis over the weekend. You're looking at the weekly charts. You literally fly through it in half an hour to an hour. It really won't take much time of you at all. Look for anything. Look to see if they're engulfing candles, or there are corn trades, or maybe there's some pin bars that you can particularly look at. And if then when the market's open on Monday morning, or maybe it's a Monday evening because of your own schedule, you can start to looking at the prices of the options and start to put a plan in place to actually to start to take to build a binary options plan. So decide how much you want to win. You decide on the duration of the bet. You decide where you want that touch or no touch to be placed. The system calculates for you the cost of the position, your stake, and then the system calculates the amount of profit you'll make if you're right, and expresses that as a traditional odds or decimal odd, and as a percentage gain. And that's part of that plan of just being able to put that together and to look at that. So, what I'll be telling you is, start slowly, okay? One of the great things about binary.com is you can start with £20 in a trading account and taking like £2 positions, okay? Very small, very cheap way to start, and as always, having a bit of live trading helps you. Do have a money management plan, and I said right at the start about understanding your own risk profile and your own appetite to risk. Never ever chase your losses, regardless of whatever type of trading you're doing. Don't over trade. Okay, sometimes when people learn new ideas, then invariably they are the keen as mustard to basically to trade everything they can see. Well, the good thing is with the weekly chart, you're not going to be putting on hundreds of trades every week. You might actually be putting on 1 or 2 positions, but it means it's very manageable. It's very easy. You can spend your time doing analysis. If you're trading like 1-minute charts, 5-minute charts, if you don't know what you're doing, things can get away from you very, very quickly. This is a weekly chart. Just take your time, enjoy it. You will make mistakes, okay, but try to fail cheaply. Start off very small, okay, and just build your experience and build your knowledge, and keep learning it, and the profits will come. What I've passed there to your shared with there is, very, very simple way to start, longer term trading, okay? And as I said, even if you're let's say a 5-minute euro dollar trader, there are still ways, it can take you half an hour to an hour of your week just to look at those. Just go away, have a look at how many engulfing candles set up, how many corn trades set up, how many pin bars set up, and across the indices, equities, indices, FX, and commodities. Start to use that to be able to start to build yourself a binary option trading plan, and you'll find it actually very, very simple. So, and as I said, finally, it's all those 4 Ps: planning, patience, probabilities, and pounds. Keep on top of that, and you'll do well, ladies and gentlemen. That concludes my presentation. I appreciate we've covered quite a lot there. We did cover a good spread, but I wanted you to be able to learn a bit, have a couple of very simple tactics that realistically you could go away and start to look at from tomorrow. Just start very simply, start small, get your understanding of how the platform works, what you're looking for. Have a little look back at how those kind of setups have played out in the past on things like weekly charts, even daily and monthly charts, and take that forward. So if you've got any other questions, I'll happily take them. Alternatively, as always, I wish you the very best success in your own trading, and wish you good luck for the future.